I want to start with something that many people in America do not want to seriously consider. Not because the idea is difficult, it is actually very simple, but because it challenges one of the deepest assumptions built into the American financial imagination. The assumption that the United States will always sit at the center of the world's monetary system. For most Americans alive today, the dollar has always been the dominant currency. It has always been the currency behind global trade, global reserves, global debt markets, global commodity pricing, and international finance. It has always felt like the foundation under everything else. And because it has always been there, most people assume it always will be. But monetary dominance is not permanent. It is not guaranteed. It is not a birthright. It is a position that is built, maintained, weakened, and eventually replaced when the conditions that created it begin to disappear. That is not an emotional statement. It is not a political statement. It is a historical observation. If you look across monetary history, you see the same pattern again and again. Rome slowly weakened the value of its money. Spain flooded itself with silver from the New World and still lost its financial power. The Dutch guilder faded as Amsterdam lost commercial leadership to London. The British pound spent decades moving from the center of the global monetary system to a currency that eventually required outside support. These changes did not feel dramatic while people were living through them. That is what matters. Most currency regimes do not collapse in a single cinematic moment. There is usually no one day where everyone wakes up and suddenly understands that the old system is over. What usually happens is slower and more psychologically dangerous. The erosion begins quietly. The numbers get worse, but experts explain them away. The debt grows, but policymakers say it is manageable. The currency weakens, but people call it temporary. Foreign buyers reduce exposure, but officials say demand remains strong. Inflation rises, but institutions insist it is under control. And then one day people realize the world has already changed. I am not saying America is Rome. I am not saying the United States is Spain, Holland, or Britain. Easy historical comparisons are usually lazy, and they often create more confusion than clarity. But history does not need to repeat exactly for it to rhyme structurally. The important question is not whether America looks exactly like a past empire. The important question is whether the mechanisms that have appeared before major reserve currency transitions are now appearing inside the United States. And in my view, they are. The first mechanism is the deficit. Everything begins there. The United States federal government is spending far more than it collects. In a recent fiscal year, the government spent roughly $6.5 trillion while collecting roughly $4.5 trillion in revenue. That is about a $2 trillion gap. And this is not happening during a declared world war. It is not happening in the immediate aftermath of a depression. It is not happening because the country is responding to a one-time emergency that will soon fade. When this is happening in what Washington still describes as a normal economic environment, that should make people stop and think. Because if the federal government is running deficits of that size during normal conditions, what happens when conditions are not normal? What happens during the next recession? What happens during the next banking crisis? What happens during the next major war? What happens when unemployment rises and tax revenues fall? The uncomfortable answer is that the deficit probably gets larger. Now, politicians will tell you there are solutions. They always do. Democrats generally say the answer is to increase taxes on wealthy individuals and corporations, while continuing to fund social programs, healthcare, climate investment, infrastructure, and the energy transition. Republicans generally say the answer is to cut wasteful spending, reduce the size of government, deregulate the economy, and grow fast enough that tax revenue catches up. Both sides contain some truth. Both sides also avoid the scale of the problem. Higher taxes on the rich may raise revenue, but they do not solve a structural deficit of this size by themselves. Cutting discretionary spending may sound powerful, but discretionary spending is not where the largest long-term obligations live. You can cut many visible government programs and still not reach the heart of the issue. The real pressure comes from mandatory spending and interest costs, Social Security, Medicare, Medicaid, and interest on the national debt. That last one is the number that should concern every serious investor. The United States is now paying over $1 trillion a year in interest. $1 trillion. Not to build roads, not to fund research, not to strengthen the military, not to educate children, not to build productive assets, just interest. It is money paid for the privilege of carrying past debt. It is the cost of previous borrowing becoming a present burden. And because the total debt continues to rise, and because interest rates are no longer near zero, that interest expense is likely to remain under pressure for years. Even if Washington suddenly became disciplined, the existing debt would still have to be refinanced. Old low-rate debt would gradually roll into higher-rate debt. The interest burden would not disappear overnight. This is the trap. The more the government borrows, the more interest it pays. The more interest it pays, the larger the deficit becomes. The larger the deficit becomes, the more it has to borrow. And that creates a cycle that becomes increasingly difficult to manage through normal political processes. When I look at these numbers, I do not look at them as a Republican or a Democrat. Markets do not care about party loyalty. Bond investors do not care about campaign slogans. Currency markets do not care about patriotism. Capital responds to incentives, risk, confidence, supply, demand, credibility, and solvency. And the arithmetic is saying something very clear. The United States government must finance the gap between what it spends and what it collects. There are only three broad ways to do that. It can borrow more, it can raise taxes dramatically, or it can create money. Borrowing more works as long as there are willing buyers for the debt at interest rates the government can afford. Raising taxes dramatically is politically difficult and economically limited. Creating money is the quiet option. It is the option that does not require voters to approve a direct tax increase. It is the option that can be hidden inside central bank operations, balance sheet expansion, liquidity facilities, and emergency programs. The professional term is debt monetization. It sounds complicated, but the idea is simple. The central bank creates money and uses that money, directly or indirectly, to support government borrowing. In the United States, that means the Federal Reserve expands its balance sheet and buys government debt or related financial assets. This creates liquidity, supports treasury markets, and allows the government to continue financing obligations that would otherwise become much harder to fund. But there is a cost. When the supply of money expands over time, the purchasing power of each existing dollar is reduced. That reduction is a kind of tax. It is not called a tax. It is not voted on. It is not debated in Congress. It does not show up as a separate line on your paycheck. But it still transfers wealth. It transfers wealth away from savers, wage earners, and holders of cash. It rewards those closest to assets that rise with liquidity. It punishes those whose incomes and savings do not adjust quickly enough. We saw this after 2008. The Federal Reserve's balance sheet expanded massively after the financial crisis. It went from under $1 trillion to several trillion dollars. Then we saw it again after 2020. I'd find when the Fed's balance sheet expanded toward $9 trillion in a very short period. People still debate why the first period did not create the same visible consumer inflation as the second. There are technical reasons. Bank reserves mattered. Money velocity mattered. The condition of the banking system mattered. Supply chain disruptions mattered. The structure of fiscal transfers mattered. But the simpler explanation is this. The first wave mainly inflated financial assets, stocks, bonds, real estate, private assets, art. If you owned those things, you felt wealthier. If you did not, you experienced the consequences indirectly through higher asset prices and a widening wealth gap. The second wave reached households more directly. Stimulus checks, government support programs, emergency benefits, and fiscal transfers pushed money into the real economy. That money showed up in grocery stores, rent, cars, gasoline, services, and daily living costs. The mechanism was similar. The destination was different. In both cases, newly created money helped finance obligations that normal revenue could not comfortably cover. That is why the current inflation fight is more complicated than most people understand. When the Federal Reserve raises rates, it can slow the economy. It can reduce speculation. It can cool housing. It can tighten financial conditions. It can signal that it is serious about inflation, but if the fiscal authority continues running massive deficits, monetary policy is fighting only part of the problem. The central bank is trying to restrict money while the government continues creating pressure for more borrowing and more future money creation. That is like trying to stop a leak by mopping the floor while the pipe inside the wall is still broken. You may slow the damage, you may make the room look cleaner for a while, but the source of the problem remains. For investors and for anyone who holds savings in dollars, the real question is not whether the dollar's purchasing power will continue to decline over time. The real question is how. Will it happen gradually through persistent inflation? Will it happen through asset inflation first and consumer inflation later? Will it happen through higher interest rates, higher debt service, and lower real returns? Or will it happen more suddenly if foreign investors and central banks begin demanding higher compensation for holding dollar assets? A prudent investor has to consider all of these possibilities. That brings us to the second major theme, foreign reserves. This is one of the most important stories in global finance, but it does not receive enough attention because it happens slowly. It does not create a dramatic headline every morning. It does not look like a crash. It does not feel urgent until the trend has already moved a long way. For decades, the dollar has been the world's primary reserve currency. Countries earned dollars through trade, accumulated dollar reserves, and recycled those reserves into U.S. Treasury securities. This created what Valéry Giscard d'Estaing famously called America's exorbitant privilege. The United States could borrow in its own currency. It could issue debt that the rest of the world needed to own. It could run deficits that would be dangerous for almost any other country. It could fund those deficits at interest rates lower than its fiscal position might otherwise justify. That privilege is extraordinary, but it depends on continued trust, and the world has been slowly diversifying. The dollar remains dominant, but its share of global reserves has declined from around 70% near the beginning of this century to somewhere around the high 50s or about 60% today. Some people look at that number and dismiss the concern. They say the dollar is still the largest reserve currency. That is true, but it misses the point. The issue is not whether the dollar disappears tomorrow. It will not. The issue is whether the marginal direction is changing. And it is. Foreign central banks are slowly reducing concentration. They are adding gold. They are holding more reserves in other currencies. They are exploring alternative settlement systems. They are trying to reduce dependence on one country's financial infrastructure. The freezing of Russian reserves in 2022 accelerated this thinking. This is not a moral argument about whether that decision was justified. It is a financial observation about incentives. When countries saw that dollar reserves could be frozen for geopolitical reasons, they understood that reserve assets are not purely financial. They are political. If you are a country with a complicated relationship with Washington, you have to ask a difficult question. Do you want all of your national savings held inside a system controlled by a government that could one day restrict your access? For some countries, the answer is increasingly no. Again, this does not mean the dollar is replaced next year. The global financial system is built around dollar infrastructure. Commodities are priced in dollars. Derivatives are priced in dollars. Trade finance runs through dollar channels. The Treasury market is still the deepest and most liquid government bond market in the world. These systems do not change quickly, but they can change gradually. And when the marginal buyer of U.S. debt becomes less reliable, the consequences matter. If foreign buyers buy fewer treasuries, someone else must absorb the supply. Domestic investors, banks, pension funds, households, money market funds, or eventually the Federal Reserve. When demand weakens, bond prices fall. When bond prices fall, yields rise. When yields rise, interest costs rise. When interest costs rise, the deficit grows. When the deficit grows, the Treasury must issue more debt. And more debt requires more buyers. That is not necessarily an immediate crisis, but it is a feedback mechanism. And feedback mechanisms can operate quietly for years before they accelerate. Now, underneath the fiscal story, the monetary story, and the reserve currency story, and there is a physical story. That story is commodities. Commodity supercycles happen when years of underinvestment in supply meet a long-term increase in demand. The last major supercycle was driven by China. China's industrialization moved hundreds of millions of people into cities, factories, apartments, roads, ports, and modern infrastructure. That required enormous amounts of copper, steel, iron ore, coal, oil, aluminum, and concrete. Prices rose because the physical world could not instantly produce enough supply to meet the new demand. Today, another setup may be forming. The first driver is the energy transition. Whether you support the energy transition politically or oppose it is not the point. The investment question is physical. Wind turbines require steel, copper, rare earths, and concrete. Solar panels require silver, aluminum, silicon, and industrial supply chains. Electric vehicles require lithium, nickel, copper, cobalt, graphite, and manganese. Battery storage requires metals. Charging infrastructure requires copper. Grid expansion requires copper and aluminum. The clean energy system is not weightless. It is not purely digital. It is built from physical materials, and the world has not invested enough to produce those materials at the scale required. Mining takes time. A major hard rock mine can take 7 to 10 years or longer to move from discovery to production. Permits take time, financing takes time, infrastructure takes time, political approvals take time, environmental reviews take time. Local opposition can delay projects for years. This means the supply response is slow, but demand can arrive faster. From roughly 2014 through the early 2020s, commodity producers suffered from weak investment. Low prices discouraged new projects. Investors demanded capital discipline. ESG concerns made large institutions reluctant to finance extraction industries. Energy and mining companies were told to return cash instead of aggressively expanding production. That underinvestment now matters. The second driver is oil and gas. This is where people often oversimplify. Yes, electrification can reduce oil and gas demand over time, but demand destruction is likely to unfold over decades. Supply destruction from underinvestment can happen much faster. Major oil companies have reduced long-cycle exploration. U.S. shale is no longer the same explosive growth machine it was a decade ago. The best acreage has been heavily drilled. Productivity gains are slowing. Capital discipline has replaced the old model of drilling at almost any cost. At the same time, OPEC producers have their own fiscal needs and political incentives. They are not trying to provide cheap energy to the world out of kindness. They manage supply based on their own national interests. That creates the possibility of a tighter oil market than many investors currently assume. The third driver connects directly to the monetary argument. Commodities are a natural hedge against currency debasement. When the supply of paper money rises, the nominal price of scarce physical assets often rises over time. This does not happen in a perfectly straight line. Commodities are volatile. They can fall sharply. They can remain out of favor for years, but over long monetary cycles, real assets tend to protect purchasing power better than paper claims when the currency is being diluted. This was visible in the 1970s after the breakdown of Bretton Woods. It was visible in countries that experienced serious currency weakness. It was visible in historical episodes where farmers, exporters, energy producers, landowners, and holders of metals often fared better than those holding only paper currency or fixed claims. I am not predicting hyperinflation. That is not the argument. The argument is that several structural forces are pointing in the same direction. The fiscal position of the United States is deteriorating. Debt monetization pressure is likely to remain. Foreign central banks are diversifying at the margin. Commodity supply has been underbuilt. The energy transition requires massive physical inputs. And real assets tend to matter more when trust in paper claims begins to weaken. That is why hard assets deserve attention. Now let me talk about how this thesis can be expressed in a portfolio. The most direct expression is gold. Gold is misunderstood because modern investors often evaluate it like a business. They say it does not produce earnings. It does not pay a dividend. It does not grow cash flow. It does not innovate. All of that is true. But gold is not supposed to be a business. Gold is monetary insurance. It is an asset outside the credit system. It is not someone else's liability. A dollar is a liability of the U.S. government. A bank deposit is a liability of a bank. A bond is a promise from an issuer. Gold is different. It does not rely on a government's willingness to pay. It does not rely on a central bank's discipline. It cannot be printed to fund a deficit. Its supply grows slowly, roughly 1 to 2% per year, regardless of political pressure. That is why central banks have been buying gold aggressively. They are not buying it because of earnings yield. They are buying it because they want an asset on the balance sheet that is not another country's liability. That should tell investors something. Beyond gold, copper is one of the clearest industrial expressions of the same broader thesis. Copper is not a monetary metal in the same way gold is, but it is central to electrification. You cannot build a modern grid without copper. You cannot scale electric vehicles without copper. You cannot expand renewable energy, battery storage, transmission lines, charging stations, industrial automation, and data infrastructure without copper. And the supply picture is difficult. Many of the world's largest copper mines are aging. Ore grades are declining. New projects are limited. Permitting is slow. Political risk is significant. And the timeline to bring a new mine online is long. The market may ignore this for a while, but eventually physical shortages have to be priced. Commodity markets are often late to recognize structural changes because Wall Street spends most of its energy analyzing equities, software, earnings, and financial assets. But when commodities reprice, they often do so violently. Energy equities are another area of interest, but selectivity matters. I am not interested in companies that respond to higher prices by chasing expensive marginal production. I am interested in companies with long life reserves, disciplined capital allocation, a strong balance sheets, and a willingness to return cash to shareholders. The energy sector spent years destroying capital. Many companies learned a painful lesson. The survivors that changed their behavior may now offer a better risk-reward profile than the market appreciates. On the other side, I have reduced exposure to long-duration bonds. This is a nuanced point. Not all bonds are bad. Short-term treasury bills can make sense. High-quality fixed income can have a role depending on the investor, but a 30-year treasury bond looks unattractive to me in this environment. Think about what you are doing when you buy it. You are lending money for 3 decades to a government with a massive structural deficit in a currency facing debasement pressure, at a yield that may not compensate you for inflation risk, duration risk, and fiscal risk. People call treasuries risk-free. They are risk-free only in nominal terms. The government can pay you back in dollars. The question is what those dollars will buy. That is the real risk. Now bring this back to the banking system. The banking stress of 2023 was not random. Silicon Valley Bank, Signature Bank, and First Republic were symptoms of a system that had spent more than a decade living with near-zero interest rates. When rates are near zero, banks reach for yield. They buy longer duration assets. They assume deposits are stable. They build balance sheets around the idea that the low-rate world will continue. Then inflation forces the Federal Reserve to raise rates aggressively. Long-duration assets fall in value. Depositors notice. Confidence breaks. And in the digital age, a bank run happens instantly. When what happened to Silicon Valley Bank was not mysterious. It was an asset-liability mismatch exposed at high speed. The government responded by protecting deposits beyond the normal insured limit. That may have prevented contagion, but it also reinforced a broader pattern. When the system gets into trouble, the public sector absorbs more of the downside. That changes behavior. If private actors believe losses will be socialized when the stress becomes large enough, they take more risk over time. This is not a moral argument. It is a mechanical one. Backstops create incentives. Incentives shape behavior. Behavior changes the fragility of the system. The investors who handled the 2023 banking stress best were not necessarily the ones who predicted exactly which bank would fail. They were the ones who understood the structural environment ahead of time. They had already reduced dependence on fragile paper claims and increased exposure to assets tied to physical reality. When a bank fails, gold does not need a government guarantee. Copper does not disappear because a lender mismanaged duration. Energy reserves do not vanish because a bank had unstable deposits. Real assets can be volatile, but they are not the same kind of claim as a bank deposit, a bond, or a financial instrument dependent on confidence in an institution. That distinction matters. Banking stress is often a signal. It reveals pressure that has been building underneath the surface. The banks are not necessarily the disease, they are where the symptoms appear. The deeper disease is the combination of structural deficits, debt monetization pressure, and political paralysis, fragile financial institutions, and a global monetary order that is slowly reorganizing. Understanding that difference is what separates investors who reposition before events from investors who react after events. Now let me close with a framework, not a trade recommendation, a framework, because individual trades depend on timing, sizing, risk tolerance, liquidity needs, tax situation, country, age, and personal circumstances. The first principle is that fiscal math matters over time. A government that spends more than it collects must eventually close the gap somehow. It can borrow, it can tax, it can inflate. But the gap does not disappear because people ignore it. You do not need to believe in the most extreme version of the story to take the math seriously. You only need to ask what outcomes the math makes more likely. The second principle is that reserve currency transitions can be survived by investors who recognize them early. The British pound did not lose its status overnight. It happened over decades. But investors who stayed concentrated in the wrong paper assets suffered in real terms. The lesson is not that the dollar vanishes tomorrow. The lesson is that concentrated exposure to one currency system becomes dangerous when the direction of policy is unfavorable. The third principle is that commodity markets often price structural change late. Equity markets are watched by thousands of analysts. Technology stocks are studied constantly. Financial assets are priced in real time. But copper mines, oil fields, lithium projects, and energy infrastructure are often misunderstood until supply becomes tight. And when physical markets finally adjust, the moves can be extreme. The fourth principle is that in periods of monetary uncertainty, the goal shifts. It is not only about maximizing returns, it is about preserving purchasing power. That sounds modest, but it is not. Protecting wealth through inflation, banking stress, currency realignment, rising debt, and changing monetary regimes is extremely difficult. The investors who do it well often own hard assets and real businesses with pricing power. The investors who fail often hold too much wealth in instruments whose value depends entirely on the credibility and solvency of the issuer. The fifth principle is humility about timing. I do not know exactly when the dollar weakens more seriously. I do not know exactly when the commodity cycle becomes obvious to everyone. I do not know which bank fails next. I do not know what event forces the market to reprice the risks. But I do not need to know the exact date to understand the direction. The deficit is real. The debt burden is real. The monetization pressure is real. Foreign reserve diversification is real. Commodity underinvestment is real. The demand for physical inputs is real. This is not a single prediction. It is an ongoing process. And the process continues. After decades in markets, one lesson stands above almost everything else. Do not let the outcome you want distort the evidence in front of you. The evidence does not care whether you are optimistic or pessimistic. It does not care which political party you support. It does not care whether the conclusion makes you comfortable. It simply points where it points. And what I see today is not a weak country. America still has enormous strengths: deep capital markets, entrepreneurial culture, technological leadership, rule of law, world-class universities, energy resources, military power, demographic advantages compared with many developed countries. But those strengths are being paired with a fiscal path that is inconsistent with the long-term maintenance of monetary privilege. That is the problem, and it is correctable. The United States can choose discipline. It can reform spending. It can reform taxes. It can make difficult decisions. It can restore confidence before markets force the issue. But if political leaders do not make those choices voluntarily, markets eventually impose discipline in their own way, through higher yields, through inflation, through currency weakness, through capital flows, through pressure on financial institutions, through a repricing of real assets. The question for investors is not whether adjustment eventually comes. The question is how it comes, when it comes, and where you want your capital positioned when it does. I am positioned toward hard assets. I want exposure to gold. I want exposure to commodities. I want exposure to real resources. I want less exposure to long-duration fixed income. Not because I know the timing perfectly, I do not, but because the structural case is clear enough. The old monetary order is not ending overnight, but it is changing. And investors who wait until everyone agrees may find that the most important repositioning already happened before the consensus arrived. That is the point. Not panic, not prediction, preparation. Make of it what you will.